Hey there, welcome to the pod. Be the boss of your money. When do tariffs really become a problem for investors? That's what we're going to talk about and the signs that you should look for to see if a tariff could become a real problem for you. I mean, like a long term problem that results in a lower net worth, which could throw off your plans. Let's get into it. We'll talk a little bit about that, and I'll be here to answer your questions as well. Here we go. All right, when do tariffs really become a problem? We saw over this past weekend that President Trump, who has the authority to impose tariffs, decided to tariff imports from Canada and Mexico by 25%, uh, energy imports by 10%. Still a lot. And China, he only taxed 10%, even though Mexico and Canada are very good, strong trading partners and allies, and we share borders with them. We make up North America. So, when's it a problem? So Sunday night, you look at your MS and your CNBC app, and you see that futures are plummeting that night, and you know it's going to be a rocky Monday morning. And sure enough, it was a rocky Monday morning. Stocks plunged. Why? Because people were selling. I mean, if nobody was selling, futures wouldn't have gone down, and the stock market would not have plunged in the morning. And by the middle of the day, Trump comes out and by tweet says, we're going to hold off for 30 days for Mexico. Justin Trudeau, Prime Minister of Canada, says the United States will hold off for 30 days after announcing a very substantial package of retaliatory tariffs against the United States, which was very significant. And, you know, everybody knows that to fight a trade war, you have to put your citizenry through a lot of pain. I I really don't think US citizens have a very high threshold for pain. And if you look at the wars we fight, if you look at the battles we get involved, we do everything by missile, by aircraft. We are told that war is going to be short, not a big commitment of boots in the ground. Politicians do everything they can to make battles as palliative as possible and as the least painful they can make them, as they should. Don't get me wrong. But here's the thing: trade war is also painful. And it's not wars that win elections. It's the economy, stupid, right? Remember that? James Carville said it's the economy, stupid, about the first George Herbert Bush. So anyway, we need to figure this out here because you're going to have to make some decisions. And one of your decisions could be to not make a decision. But I want your decision to be a decision, not because you ignore things. So when do tariffs become a problem? So let's look at it like this: tariffs are volatility, and I like to say there's a difference between volatility and risk. Volatility is the ups and downs of your investments when your need for the money from those investments is far off into the future. If your need for your retirement assets is 20, 30 years away, I'll say even 10 years away, volatility is not a problem for you. You just wait it out. But if your need for your assets, if you're facing a near-term need to convert your assets into money to pay your bills in retirement, now volatility in that case becomes a risk. And the risk is that you have X amount of dollars for your planning, for your life, and that number gets cut by a substantial amount. And you're too old to just leave the money in the market and wait it out because you need it. So you no longer have the staying power that you used to have when you were younger. That's when volatility becomes a risk. When the market goes down before you need it, oh, you took a lot of risk. the market goes down, you don't need to touch your assets for a long time. That's volatility. It's part of the process. You expect it. Now, this doesn't mean that when you get close to retirement or going to retirement, that you should move all of your assets into out of the stock market, out of risky assets, for example. But you should be making some kind of plan that's diligent, some kind of plan that is well thought out in how you're going to balance reducing your risk, but still having an ability to grow your money to keep pace or ahead of pace of inflation. All right, so let's get back to the tariffs. The tariffs caused a massive amount of volatility on Monday morning, and people sold. People decided they can't take the pain. And by the end of the day, these people were probably feeling pretty dumb. And then the market went up yesterday and today, and all of a sudden, people are like, it's like we forgot about what happened over the weekend with tariffs. And I said this a few episodes ago, about 2 weeks ago, that this volatility you're seeing in the market, it's making financial planning very difficult, because if you're close to needing your money, I'm not talking if you're 30 or 40 years old. If you're 30 or 40 years old, even 50, 55, 20, and you're accumulating assets. I know that's a big range, 20 to 55, right? 58. Okay, we could keep going. But the point is, if you're still in the position where you're socking away as much money as you can, and you're putting money into your retirement plan and regular taxable brokerage accounts, a down market is your friend. A down market is a good thing, because you're, for the same amount of dollars you're putting into the market every month in your retirement plan, you're getting more shares of whatever it is you're investing in. Mutual funds. I'm going with stock mutual funds. You're getting more shares. So you're dollar cost averaging. And a down market is your friend. I mean, imagine nobody wants the market to go down. Well, listen, it's a generational thing. Maybe baby boomers, boomers don't want the market to go down. But Gen X's, millennials, Gen Zers, we want the market to go down, because we're still accumulating assets. It's still important for us to be investing. We're still socking money away as much as we can. So let's just get that out of the way. So the volatility, though, on Monday from the tariff announcements over the weekend caused people to lose money. Now, we held steady here at Client First. We didn't make any rash decisions. We're not making decisions based on whether or not whatever the thought process is of any politician. We're not mind readers, and it's not something that we think is even worth trying to attempt. We're sticking to our plan. We're investing client assets and helping them with plans, and when they could collect Social Security, or when they should retire. Should they buy a vacation home? Should they sell their family home and move elsewhere? All these things that go into it. Should they keep helping their kids, financially? So many things go into it. How do you prepare for college for your children? Do you have a will? There's so many other things to talk about besides the stock market. But when you have an acute reaction to news, to geopolitical news, it definitely brings the stock market to the fore, and people get scared and they say, I'm going to have less money. I'm going to lose money, and this is going to ruin my life, and I have to become afraid and sell. But that did happen to people on Monday. And then you get the news that, well, we'll delay tariffs for 30 days and stock market goes back up. And this is why you really have to understand that it's you don't have control over this. So it's not that tariffs are a problem for investors. It's that you could be a problem for yourself. Now, that might sound harsh, and I don't mean to sound harsh, but you really have to become a real investor, a stick-to-it long-term investor at this time. Not someone who's in the market and you're saying, oh, I'm a long-term investor, but the market's been going up a lot the last few years. Tech stocks have been flying. So there's a lot of people. There are so many people who say they're long-term investors, but it's easy to be a long-term investor when your investments are going up. This is easy. I'm a long-term investor. Yeah, don't worry about the down market. But, it's like not worrying about a fight if you've never been in a fight before, but then all of a sudden you're in a fight. Now, all of a sudden, you're scared and you're wondering, how many times you get punched in the face and get your teeth knocked out. I have all my teeth, see? So these are the things that you really have to prepare yourself for. I don't think this volatility goes away. And maybe the market could be fine without all the tariffs, but I think it's healthy if there's actually something that takes a little steam out of the market. I think it's healthy if there's something that takes a little froth out of the market, because if the market goes up in a straight line, it comes down. But if it goes up too much, it could come down a lot and stay down for a long time. For example, the tech wreck of 2000, the Nasdaq went down about 80%. It took 15 years for the Nasdaq to get back to even. How many people who are enjoying these wonderful returns in the stock market remember taking 15 years to get back? You want to talk about watching paint dry? Wait 15 years for an ETF or a mutual fund or a stock to come back. That, my friend, is a really long time to wait. All right, so the volatility from the tariffs is not really a problem. It's that you're not doing the right planning. You're not really preparing yourself mentally for the volatility. So if you have funds that you need over the near term that you need to convert to cash to pay your bills, to pay for your lifestyle, the money should be already in cash well ahead of the time when you need it. A lot of people believe in just-in-time inventory, which, as we saw at the pandemic, is a really tough way to stay supplied. A lot of people believe in just-in-time selling. So people don't want to sell until right before they need the money. But if you do that, you're giving up some control. You're now not doing things on your own terms. You're letting the market control your decisions. So I want you to have a strategy to deal with the volatility. Now, the volatility from the tariffs is not really a problem if you're investing properly and you know that money you need for cash is already in cash. It's not a problem if you really are a long-term investor. But there are a lot of investors out there who don't know what it's like to get kicked in the teeth a couple of times. And every 10 or 15 or 20 years, we have to go through this, and a whole new crop of investors get caught in it. They get over accumulated in the same aggressive, risky stocks. And then when they finally turn around, people just can't believe they're down so much. They won't sell because they always believe that the stocks that they have that are down will come right back up. And they just don't acknowledge the losses until they're despondent, and then they sell, and then they miss the gain again. So what I want you to do is have a strategy that deals with volatility. And there are a couple of things you could do with volatility. You could use it to your advantage by putting below the market buy limit orders for stocks or ETFs and take advantage of the volatility. So when the market does have an unexpected down day, you could use that to your advantage and purchase more shares. Or you could just set it and forget it and just buy, and don't worry about what the market does. Just say, I'm in it for the long term and I'm not going to look for 20 years. Now, if you bought a house and you're raising a family and your family's living in the house and your kids are young and you're not moving out of that house until your kids are well past college, 5-10 years after you buy your house, you're probably not looking at the value of your home because there's no need to. You have no intention of selling the house for another 15 years or so, maybe 20 years. I think it should be the same thing with the stock market. There's no reason to be worried about it because you don't need the money yet. Now, granted, there are certain things that happen with individual stocks and some ETFs that could go down and never recover. But that is why we diversify, because you never know. Now, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Other things you could do to protect yourself from volatility is invest less money in the stock market. Maybe you have some of your money in bonds or CDs, short-term bonds or CDs, T-bills, cash equivalents. You're giving up upside, though, to do that. You're giving up upside potential growth. You're giving up returns. But everything has a sacrifice that you do in investing. If you invest all into the stock market, you're potentially maximizing your returns, but you're potentially maximizing your losses. So you have to find the happy medium that's right for you. I had a client in my office the other day, 51 years old. Should we start moving money to bonds? Was the question. Well, actually, I already did start moving some of the money to bonds, but not a lot, maybe 10% of his overall portfolio. When we get to like 30, 40% into bonds, we've started that already. but it's going to be gradual and it probably won't be up to like 40, 45% bonds until the client's about 60 and he's not retiring until 65. And I know his risk tolerance. I have some clients who are 65 and ready to retire, and they're still mostly in stocks, but they have a very high risk tolerance, and they have so much money that they could, the stock market's not going to affect them. Maybe they have real estate, they have rental income, things like that. So it's all different for everybody, but the volatility is here to stay. But it's not a problem per se. It's a problem because of you if you're not prepared for it, either mentally or cash wise. You have to be prepared for the volatility. We have no idea what politicians will do. We have no idea what Trump will do with tariffs going forward. All we know is it's going to be a bumpy road. We always have to deal with unexpected geopolitical events. And these geopolitical events that are unexpected, I feel, will be no different than the ones in the past, which the market will skip over. And one day we'll be talking about a whole new set of geopolitical issues, and we'll forget about the ones we're facing now. And that's the way it goes on and on and on. Thanks for watching. I'll see you tomorrow.